If you struggle with understanding contingent liabilities, this video will explain what they are so that you can make sense of any contingent liabilities included as footnotes in your firm's financial statements. Contingent liabilities, in spite of their name, are not included as liabilities in our firm's financial statements. At least, not yet. To be a liability, an aspect of a business needs to win the 3 time-based trifecta: past event, present obligation, and future outflow. There are 3 types of contingent liabilities, one of which is very rare in practice. The first type of contingent liability is probably the most common. For this type of contingent liability, there is a past event, but not yet a present obligation. The past event has occurred, but whether this past event results in an obligation of a firm depends on a future event occurring. For this reason, this type of contingent liability fails the definition of a liability. The present obligation does not yet exist and is dependent on a future uncertain event that is not probable occurring. Examples of contingent liabilities that are a possible obligation that arises from past events and whose existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events, not wholly within the control of the entity, and so fail the time-based trifecta of being a present obligation, are: a lawsuit is commenced against a firm, but its outcome is not yet known; a guarantee by a firm to assume the responsibility for the debt of another party, should that party default; an indemnity by a firm to accept the risk of loss or damage another party may suffer. Each of these are not present obligations because they depend on the occurrence or non-occurrence of one or more uncertain future events, not wholly within the control of the entity. In these examples, the uncertain events are the outcome of the lawsuit, whether or not the other party defaults on its obligations, and whether or not the other party suffers any loss or damage. Common definitions of contingent liabilities often only describe this one type of contingent liability. Some people describe contingent liabilities as potential liabilities. This is true for those contingent liabilities where there is a past event but not yet a present obligation. But there is more. We can also have contingent liabilities where there is an existing present obligation arising from a past event involving a future outflow, but where it fails to win the quinella, probable and measured reliably, to be recognised, i.e. included, as a liability in a firm's financial statements. These types of contingent liabilities are almost always items that would indeed likely be a provision, except that it is not probable, i.e. less than 50% probable, resources will be expended to settle the obligation. An example of this would be where our firm has hired a venue to host a conference and indemnified the owner of that venue against losses that may be suffered if attendees damage the venue. The conference has been held and there was some minor damage to the venue. There is a past event and a present obligation. but the owner has not requested compensation for the minor damage, and our firm may consider it possible, but unlikely, i.e. less than 50% likely, that the owner of the venue will require any payment from the firm. In this case, there is not a future outflow that is probable, and so there would not be a provision, and a contingent liability would be disclosed in the footnotes. There is also a third type of contingent liability that, in practice, is likely to be extremely rare. The second leg of the quinella to be recognised as a liability is to be able to be measured reliably. The accounting standards make it clear that it is extremely rare that our firm will not be able to make an estimate of the obligation that is sufficiently reliable to use in recognising a provision. In these extremely rare cases, we would disclose a contingent liability. Our firms do not recognise or include contingent liabilities in their financial statements. Rather, contingent liabilities are disclosed in footnotes. Have a look at your firm's footnotes to see if your firm has any contingent liabilities and what disclosures your firm may make about contingent liabilities in its footnotes. For further information on contingent liabilities, go back to Chapter 6, Section 6.4 in the study guide, and also review the Liabilities Weekly questions. Also answer, write and rate questions on liabilities in Peerwise.